Hello, and thank you for joining today's Family Office Network's webinar series featuring Trac Unicorn. Fred Campbell and Joe Aaron, the principals behind Trac Unicorn, will be presenting for us today. They have known each other for over 40 years and over this time co-founded an earlier business, advised each other in their independent businesses, and Joe invested in several of Fred's startups. Most important to Trac, they each started separate businesses in 2014 and 2015 on the best ways to apply the science of collective intelligence and data analytics to investing in startups. Joe and Fred joined forces in early 2019 to build Trac. At the end of today's presentation, we will have time for Q&A. We encourage your questions, so please use your questions chat option on your screen to send those over. David Wield is CEO of Wield & Co., the investment bank that found Trac Unicorn, and David's going to start us off. David, I'll let you take it from here.
Terrific. Thank you very much, Lindsay. So you all know the books written by Michael Lewis, some of the major Wall Street tomes, Wall Street classics, including The Big Short, Liar's Poker. He also wrote Moneyball, where the thesis was that the conventional approach to baseball insiders was outdated, subjective, and flawed. And the book argued that the Oakland A's front office could take advantage of more analytical gauges of player performance to field a team that could compete against all the richer competitors in the Major League Baseball. So fast forward, and they spent $44 million on their payroll, while the New York Yankees were spending 3 times that amount of money, and they made it consistently into the playoffs. So it was really kind of earth-shattering. And then subsequent to that, you may or may not know that Mark Cuban, who was the owner of the Dallas Mavericks, actually won a couple of championships with the Mavs because of his application of data science. So Trac Unicorn is the leader in applying data science to picking future unicorns, companies that in the future are more likely to hit the $1 billion or larger valuation mark. And their baseball players and basketball players are angel investors. And they track, analyze, and identify the best of the best, the so-called super forecasters. If you know Philip Tetlock's work at the University of Pennsylvania. So these super forecasting angels, we believe, skew the odds of identifying future unicorns. We think their repeatable process is part of a tsunami in how successful investing is occurring and will occur in the future. So with that, I am extremely proud to introduce Trac Unicorn and its principals. Joe, you want to take it away?
Thank you, David. That's a nice buildup. I appreciate all those kind words. Let me tell you a story about how we identify the very best early stage venture investors in the world, and we call them super forecasters. Our fund invests in the same companies they invest in. We all know Warren Buffett's one of the greatest investors of all times, and almost everybody on this webinar would be better off if they had bought a stock every time Warren Buffett did. So we identify these super forecasters with 12 metrics, and I'll touch on 2 or 3 of them, but the most important one is the follow-on rounds. If you have a portfolio of companies and one of them raises a follow-on round, you get a step up in basis. And that delivers 2 metrics that are key to us. One is it gives you a return multiple. You just doubled your money. 2, you can take the percentage of your entire portfolio and you got a hit, back to the Moneyball analogy, your batting average increased every time a company raises a follow-on round of financing. So let me give you 3 portfolios and describe them. Larry, Mo, and Curly. Larry invested $1 million in 10 different companies, and every one of them raised a follow-on round of investment with a higher valuation. So now Larry has doubled his money and he has a batting average of 1,000. He will never be heard from again. He will never be able to be a venture capital fund. Mo, on the other hand, he makes 10 investments for 10 million and 9 of them go out of business. but that 10th investment becomes a unicorn. So now Mo's portfolio has made 100 million, because if you invest in a unicorn in the seed stage, it will give you 100x. So now Mo has a 10x return on his portfolio. The press loves him. He's the new visionary, and he raises hundreds of millions in his next venture capital fund. We've identified the Curlys of the world, and Curly made 10 investments over 10 years, and every year Curly's investment raised a follow-on round. The ones that are 10-year-old raised a lot of follow-on rounds, and the one that is 2 years old just raised one. Unicorns, as an average, raise a new round of financing every year. So Curly is the best investor in the world because he combined two metrics, the return multiple and the batting average, power law and consistency, and merged them. So let me just tell you how good the super forecasters are. You can see that we've had 96,000 investors that we picked. We've given all of them a score, every one of them a score. And it's 0.1% of all the investors. You have to have invested in 10 companies to be a super forecaster. I see in October, we had 134 super forecasters. I think last month it was 137. But the average portfolio size of these super forecasters is 39 investments. Startling to me, it's startling that 600 or 62, almost 63% of their investments are profitable. They raised a follow-on round of financing. Then this startling number of 91x, that's right, put in $1 million and get 91 million back. That's the return multiple. And that's the reason these super forecasters are so good. And you can't score that high of a return multiple if you don't invest in a couple of unicorns. The average super forecaster has invested in 3.4 unicorns. So now we've got 64,000 startups that we have to whittle down. The question is, how do we whittle them down? And if my friend Fred will flip to the next screen.
Oh, give me the sound, Joe. You got to go bing. There you go.
Okay, bing.
Okay.
64 out of 64,000 startups over the last 20 years, 95% of them failed to have an investor group quality score above 0.6. Now, remember, in the startup, we took all of the investors, and whether they had a super forecaster or not, and we added up their scores. And 95% of the 64,000 failed to score above 0.6. But over on the right side here, 5% or 3,200, they did score above 0.6. And the good news for the 5% group is that they invested in 60% of all US-based super forecasters.
Unicorns.
Excuse me. Thanks for the correction there. Unicorns. So we've got, every time we pick a company for our portfolio, it's got a 15% chance of becoming a unicorn. Beep.
I'm going, right?
You're doing a great job, Fred.
I'm working, Joe.
We're called the Unicorn Fund because we want to invest in unicorns. We don't care about the other companies. They deliver the return multiple. We're going to raise between 25 and 50 million. We had our first close in May. We raised 15 million. We're going to make about 30 investments. And we believe we're going to return 10x of your capital. and the investors in the fund get double their money back before Trac earns a carry. So before I turn it over to Fred, I want to go through the 3 objections we get. Everybody gives these objections. The first one, I don't have to spend any time on it. Well, Fred and you get along. You've already heard Lindsay gave a great story on that. The second one is, how do you source the deals? How are you going to find these future unicorns? We don't source them. The super forecasters source them for us. We don't need that. So the black box will kick out the companies we should be looking at. Now, the last objection, which Fred has to prove to you we can do it, is how do you get these hot deals? Let me tell you, they're hot. Make no mistake about it. Every fund we approach, or every startup we approach, we estimate has 1 to 2 venture funds standing in line wanting to invest. So we have to prove to that startup that we've got something different to offer. And we do. How do we sell our money? Fred's going to show it, but all we do is bribe that company. We show them why they have to have us on their cap table to create value because of the data we give them. So Fred, that's your being, and don't mess this up.
I'll try not to, Joe. Thank you, everybody. We really appreciate the opportunity to come here today and tell you our story. I'm going to start with kind of work backwards, if you will. I'm going to talk about the 5 investments that we've made to date. So as Joe said, we're a first-time fund. We launched in May. We're on track to do about 1 investment a month. These are our first 5. We've got several more that are in the works. Probably 1 will close, maybe 2 in December. I will also say that the highlight here that I'm only going to be touching on, kind of give you a taste of what we do and how we do it. And if you are interested, we can do a much deeper dive on a one-on-one call. I do want to point out, one of the first things you hear is you can't get into deals where there's already a big venture firm in the deal. So these are companies, the bottom down here are companies, investors that were already in the deal before we came in. So US Venture Partners, Founders Fund, Google Ventures, so forth and so on. We got in the deal. So the question is, how do we identify these companies, and then more importantly, how do we get in the deals? Or both are important. So let me just get out of this for a second and move over to this. I'm gonna, again, there's a lot of information. This is the technology that Trac has invented to identify future unicorns. And as Joe said, we start by analyzing the investment performance of about 100,000 investors at this point in time. And we analyze them on 2 kind of silos. One is their overall investment. How many, like for example, Anthony has made 71 investments. He's returned 37 times his invested capital, and his return batting average is 592. That's his overall. But for the company, and we're looking at here Troops, which is our last investment. For Troops, the only thing we care about is the industry specific to Troops and the performance of these investors within that industry. So here we have the industry investments, the industry return multiple, and the industry batting average. That's what matters the most. And again, we have that for every investor on every vertical, on every industry sector, so we can get this money ball playing specifically to the investments that we're looking at. So again, summarized on top here, this company qualified, Troops qualified, because it had 3 super forecasters. That gets you into the decision set, but it doesn't mean we invest in you. You have to have industry expertise. Well, it turns out that Troops had 5 industry experts. It has 5, what we call 5 industry super forecasters, 5 industry experts, and then 13 qualified investors. And the important point here, again, there's probably more detail than we even can go into much here, but you can look at here the return multiple, as Joe mentioned, for super forecasters, industry experts, and qualified. A typical VC is in this blue bar right here. That's a typical VC, but usually a much lower batting average. So we look at this data, and it will automatically, our system will automatically produce a group of investments that we can make. And let's see how fast this thing loads. So you'll notice here, Troops was one of our target companies. So we have 213 companies that meet our criteria, and that's as much as I'm going to show of that because that's very confidential. So now we've got this Moneyball approach to identifying the best investors. They help us identify the best companies. We grade each company on 3 key metrics, one of which we just showed you, which was the investor group quality score. They pass those, we want into the company. Now, how do we get into the company? Let me show you that. So does everybody see this customized exclusively for?
We do.
Okay, good, thank you. All right, so when we went to Troops, troopsai.ai, Troops had over 2 years of capital in the bank. They did not need our money. The only reason why we got the CEO to sit down with us is that he wanted information that would help him improve his odds of becoming a unicorn. And we can do that. So as Joe mentioned, there's kind of 2 things we have a lot of information about that our Moneyball works. One is the quality of investors. The second is the competitive landscape for every company. We often know more about their competitors than the company CEO does. Quite frankly, they don't have time to keep track of all the competitors. They may know the top competitor, but they don't have a lot of information about all of that. We can provide that in this dashboard. And I'm just gonna, again, very quickly show you a few things. So the first thing I'm gonna show you is that we give the CEO access to 100,000 investors that they can look up. I just loaded here this gentleman. He's a very good investor. And he's made 78 investments in these different verticals. Overall return multiple is 16.89. He's a very, very good investor. And his batting average is 479. We show them all the investments this gentleman's made. And we also show them how they can connect with this person to get a warm introduction. These are Troops investors and the investments they've made in these companies that are the same as this particular gentleman. So they most likely have a warm introduction if they want them. Now that's a lot of work. So we also then go through and pull the 100 best investors for this company's next round. Based upon our algorithm, these are the highest scoring companies and individuals. And again, these 100 best investors for Troops next round, we tell them, here's how you can connect with them. There's 72 of these 100 that your investors have co-invested in the company, so they probably know these individuals, or they most likely can make a warm introduction to these individuals. That's right there. The CEOs love this information. This is probably the next page, the most popular thing that we offer them. Valuation for your next round is kind of a voodoo. That it's kind of like you grab it out of the air or someplace else. You really don't have good quality information to determine valuation. Well, we do. We go through our database, and what the company does is they enter the amount of money they've raised to date, which is $21 million in the case of Troops, and I just estimated what they're likely to raise next round. They can just put whatever they want in there, what they're likely to raise. And then what we do is we look through our database and we find all similar, this would be a 3rd round or a Series C for the next round for this company. We found all Series C deals in the industries that relate to this company and all verticals, and then we give them access to there's 398 comps in the last 2 years for the same series in the right categories. And here's all the comps. So the company now walks in with very accurate information about what their valuation should be. When they talk to a VC, and we tell them, by the way, that they should be in the 75 percentile or above. Based upon our methodology, we generally won't invest in a company that's not in the 90 percentile. So this gives them information that they just don't have access to. VCs have a lot more information here. So it's not equal, and now this equalizes that. I could go on here for a bit longer. There's a whole bunch of competitor information. Probably the most important thing I just want to highlight really quickly here is we have technology that will identify the competitors for a company. There are whatever, there are 10 or 11 shown here. The blue marked ones are direct, and the other ones are we consider indirect competitors. The thing that the companies love the most is we tell them, here are all the investors in your competitors. So if you get a call from Andreessen Horowitz, just know that he's already an investor in People.ai, which is one of their direct competitors and probably, one of the market leaders. So, and as you'll see over here, very few of these investors have more than one investment in a space. So at worst, you're probably wasting your time if you talk to them. I mean, at best. And at worst, you're probably giving away competitive information to your competitors. So don't talk to them. This information and a whole bunch more that we provide is getting us into deals. And I had a mentor of mine who was a senior partner at NEA, a guy named Mark Perry. And Mark was advising Joe and myself early on, and he said, if you can get in a quarter of the deals that you identify, you're doing as well as NEA, which is one of the largest VCs on the planet. We believe we can get into about half the deals that we identify with this technology and others. We're the only VC firm that provides this kind of data with their capital. You only get this data if you give us an investment in the company. So that's it for mine, and I'll turn it back over to you, Lindsay. Maybe not.
Good,
Thank you.
Hello. Thank you, gentlemen. Great job. Again, we would like to open up the platform to questions. So using your questions chat option on your screen to send those on over so we can answer them. David, is there anything that you would like to add while we wait for some questions to come through?
Yeah, sure. I mean, look, first, I've said this before, and I mean it. It's the first-time venture capital fund I've ever seen. There's an amazing amount of tech. I talked to one of the guys that reports to Abby Johnson at Fidelity, and their view of the world is that all the alpha is moving into private markets, and so having some exposure to these markets is obviously critical. And I think because of the highly regimented approach to this, I think it has the potential to significantly improve people's outcomes. And I know maybe Fred and Joe can speak to it a little bit, but they back tested it quite a bit. Technology. I just like maybe people should hear what they saw in that back testing, and then also just mention that the minimum for those that are thinking about stroking a check, it's the minimum investment's $500,000, and if people want to reach out to me, they can get to me directly. I'm happy to have a conversation with them, and obviously the gentlemen are happy to sit down and do one-on-ones with folks as well. But anyway, could you take that question, Fred or Joe?
Fred, you take it.
Sure. This is a point of soreness on Joe's part. So Joe came to me. He started DOS Analytics in 2015. I started CrowdSmart in 2014 rather. And we were helping each other. We were both in similar spaces, as Lindsay just mentioned recently. And Joe came to me in late 2018 and said that his technology could identify future unicorns within 2 years of these companies' existence with 70-something% accuracy. And I said, that's pretty good. And long story short, we agreed that we were going to join forces and start Trac. But I said, before we do, we need to test your technology. And Joe and Dr. Merrick, his chief scientist, hadn't done a lot of blind testing, a lot of false positive testing, yada yada yada. And the bottom line is that I acquired 45,000 companies, and the information from these companies, and we ran it through the algorithms, and it gave back, said we should invest in 1,217 of them. They did not know which companies that were going to come out of it. They didn't know what they were. They just had the data about these companies. And of those 1,217, 89% of those companies, this is over a 20-year period, and 89% of those companies would have been profitable, which was right there. You're already amazing. And I set a false positive metric for us, our fund, at 3x. So if it hadn't returned at least 3x, it's considered a false positive. You made money, but you didn't make that much money. 61%, not 72, made that metric. And you might be familiar with something called the power law in the VC business. So 6% of a typical fund from Sequoia, Klein, or whatever returns over 60% of the fund's profits. The power law for this group of investments was 22%. That 22% of those investments return more than 10x the capital invested in those companies. And the overall portfolio, an amazing 59 times invested capital if we had invested when we could have. Now, you couldn't have gotten in all 1,217 companies, but so he wasn't exactly right. He was off a little bit, but still pretty darn amazing blind test. I don't think there's anything that even be close to that in terms of blind testing. So, Joseph, you want to add anything there other than your feeling of that I betrayed you as a friend?
Well, right, and he destroyed my marketing idea. I felt we had proved that super forecasters was predictive about unicorns, and he disproved that. He took my #1 marketing idea away from me, but I'm not sore or anything.
Yeah.
Thank you, Fred and Joe. I'm going to go ahead and jump into some questions that I've pulled through here from the attendees. First question is from Frank Lackner. He's asking, where do you get the information regarding the super investor investments?
I'll take it. There's 3 sources, Crunchbase, CB Insights, and PitchBook.
Great. Moving along.
If I can just add really quickly here. That the Moneyball approach that we're doing would not have been possible a decade ago, and really not even possible 5 years ago. That's what Joe's DOS Analytics was doing, was trying to aggregate information on investors. We've got multiple companies now that are actual billion-dollar companies that are just acquiring data on early stage companies, on all sorts of stuff on those companies, on web traffic, mobile traffic, media traffic, all sorts of stuff. And so what Joe just said is the information we get on investors primarily comes from PitchBook, CB Insights, Crunchbase. It also secondarily will come from AngelList and LinkedIn.
Perfect. Let's see here, moving on. Mitchell would like to know, where do you get the data from? I think you just kind of
I think we just talked about that.
Similar, right? Okay, I just want to make sure everyone's question gets asked.
If you want to go into a little bit more, we do get data from, so we track information on the company's capital formation, the investor quality of that capital formation, their media metrics, so how much attention they're getting from influencers, social media, so what kind of customer reviews they're getting, and this and more. So this information will come from, in total, about a dozen different aggregation sites, and we also cross-reference them because none of them are right. So you have to filter out the garbage to get to the actual truth. And I will add one more thing here because it's an important part of the data. If we do not know something, we record it as a big 0. So every one of the super forecasters that we have has some percentage of their portfolio that we've written off because we can't determine what the valuation is of those companies. And we know that's too aggressive. That's just the way it is, because you will never get 100% of anything. The data just is not quite there, but it's sufficient enough. So if anything, we probably have missed 20% of the super forecasters because we just don't have enough data to identify every one of them.
Thanks, Fred. Okay, let's see, moving on. Elliot Hall, he says he's a founder of what he would think would be a definite unicorn in the making due to their signed contracts. Do you invest in fintech businesses?
Yes, but only if they have a super forecaster in his group of investors.
Perfect, thank you. Let's see here, moving on, Joshua Fieldman, he's got a lot here. Let's see, first question, how big is the fund currently and how much has been invested? David, this might be for you.
Well, I mean, we're going out to do 50 million. They've raised between 12 and 15. I think the close rates on, by the way, of people doing one-on-ones is around 50%. It's been one of the most remarkable close rates I've ever experienced, and I've been on the street for a long time. I think one of the things that's not in the back testing, and I'm just going to share a view on one of the things that I love, is that I was, doing some diligence with the firm, the AI firm that Fred had run, and one of the nuggets of information that kind of came out of what they call collective intelligence, where they seed expert panels to look at deals, is that one of the markers for future success of companies is their ability to finance themselves, right? And so it's a very significant percentage of their collective intelligence kind of weightings. And what I love about this, which is clearly not in the back testing numbers, is you give somebody this dashboard and ability to navigate investors, and it's got to take that part of the model up significantly. How much, we don't know because it hasn't been seen yet. So not only are they predicting companies that have the right stuff, so to speak, but they're also potentially going to make them more successful through the sharing of this data.
Mm-hmm. That's a really important point, David. That you need to continue that trajectory, and the way you continue that trajectory, among other things, it's like analogy would be a kid going through school, right? You have a great kindergarten teacher, angel investor, but when you get to college, you need a different level of professor. You need somebody who has experience. Later stage companies can help them navigate, international expansion, whatever it may be, and we can help. We can identify who are the best within each stage of a company, that they can use that to go attract those companies, those investors into and get them on their board of directors.
Great, thank you. Next question, does past...
Actually, there's one part of that, I'm sorry, Lindsay. Yeah, okay. The average investment we shoot for, we're looking for 30 companies or more. So that we like to have $1 million in each of these companies, so we can, and then have a little bit, if we have a $50 million, if we get to the total amount, we'll have a little bit left over for follow-on rounds. So $1 million is our target investment for the initial investment.
Great. Okay, let's see, moving on. Next question, does past performance replicate itself?
No, bottom line, Joe's analogy with that curly motor Joe, that one guy who had one unicorn, he had great, but he had 9 wrong, right? What Professor Tetlock, and I recommend anybody who's interested in human prediction, collective intelligence prediction, pick up the book Super Forecasting: The Art and Science of Predictions. Trac is a product manifestation of that book, in essence, right? And most people regress to the mean. You're good in a set of predictions. You're good, let's call it 20% of the time, right? If you're a decent predictor. For whatever reason, super forecasters do not regress to the mean. And that's what we're looking for. And what Professor Tetlock found is about 1/10, somewhere between 1% to 1/10 of 1% of any controlled group, you'll have a group of super forecasters. And again, you have to read the book to understand why that is, and he believes. but that's just the numbers. So you identify these people, and I will tell you, very important, once a super forecaster is not always a super forecaster. As Joe just said, we got super forecasters come and go all the time, because our methodology, you can think of a investment curve for every investor. You get a little better over time and you start getting really good, but for whatever reason, you're getting tired of making money, you have other things come in your life, you get a divorce, whatever, you go down. And so there are rare that you'll stay at the top. Warren Buffett's one of those people, you could argue, although I think he's probably starting to drop it as well. But we look for that in our algorithms, is where you are on that curve. We need to make sure you're still predictive. And I will tell you that reputation, as Joe mentioned, that follows accuracy. So the people you hear about, you know about, a lot of them are no longer super forecasters.
Thank you. So kind of adding on to the questions we had earlier regarding the data, someone would like to know how you validate the data from the sources that you listed.
Joseph?
When we talk to a fund company, we show them all of their investors that we've gotten from the data sources. And without exception, they say we've got them. Now, they may say we have missed one out of, the average unicorn has 24 investors, and we're going to have one or two missed possibly, but the data is plenty accurate. That's all I can say. We ask them to verify it. We don't ask all the companies to verify. We trust the data, and we have to trust our sources.
Yeah, I would say that we are currently integrating with more deeply with one of the databases, because we found their data to be a little bit more accurate than some of the others. So those that use self-reporting, like Crunchbase, not as accurate. AngelList, not as accurate. But you got to cross-reference. And you also, when in doubt, you have to just assume the worst. And so that's kept us safe. So we probably underestimate, our methodology will underestimate the performance of investors. And it will miss, as Joe said, one or two investors in a typical company, just because we're absolutely not sure, because it may be misspelled, right? We have people with multiple spellings. We don't really know if it's the same person or different people. So we just assume the worst.
If I could, somebody had asked what the terms of the investment were, and let me just run through some of the structural terms. Besides, I told you about the $500,000 minimum investment size. It has a 2% placement fee associated with it out of the front end. There's a 2% management fee. There is a 20% carry. It's a pretty standard, if you will, pricing formula. I would also mention that one of the things that they didn't speak to is they have a fairly good sized group of advisors to the fund who have lots of relationships that may also help them get into deals through those relationships that they want. And so that's another asset of the fund. But right now it looks like the killer app is the dashboard, because it's so incredibly leverageable for CEOs.
Thanks, David. Let's see, Alice would like to know, how can one propose a company to the fund?
Oh, I'll take it. Alice, we'll take your call anytime. And what we'll simply want to know, you give us the name of the company, we can tell you if they have a super forecaster or not. That's the only way you're going to get there, but she's welcome to call.
Yeah, we say on the website, tracvc.com, that we will not waste your time. And if we call you, we're ready to invest. You're done. well, we've finished our due diligence. When we call you, we're ready to invest. We'll wire the money the next day. But at the same time, if we haven't called you, there's probably a reason for that. But as Joe said, he'll take your call because he's such a good guy. So.
Thanks, Fred. Joe is a very good guy. Yes, that personality too, right?
My mother's watching. Thank you very much.
All of his favorite friends are behind him on the wall, by the way. So.
Yeah. Now, this question might need to be discussed offline, but someone would like to know if there was a list of the super forecasters that you can share or give examples of a super forecaster that you have.
Joseph, you could probably give it an example.
Yeah, there's several on there that you would know. Mark Andreessen's on there. He's going to fall off this next year. He's definitely falling off. So is Ben Horowitz. So is Peter Thiel.
Be nice to some people. Just say who is good, Joseph.
Okay, Ashton Kutcher is the real deal. Ashton Kutcher is. But I'll tell you who I think the best investor in the world is. It's David Sachs. And if you don't know who he is, that's okay. That's the reason we're going to make the big bucks.
Yeah, David Sachs is probably made about 100 investments to date. His return multiple is about 900 times invested capital, and he's right about 60-something% of the time. Unbelievable. He's founded Kraft Ventures, which is not having the kind of success that David is personally, but maybe they'll change that over time.
He has partners.
Yeah.
You got to remember, we break up the super forecasters. You got venture capital firms over here. They don't have a batting average of 500. Or because that's the minimum. That's the lowest I know of. It's 500, and you've got individual partners within a VC fund that led deals, and from that data we can determine that individual partner is a super forecaster. And for instance, Kleiner Perkins has no super forecasters. And Sequoia has 33 partners.
Be nice. These are nice firms.
It's super. Sequoia has 33 partners, I think, and 2 of theirs are super forecasters. So you just never.
And Joe, just for clarification, when you're looking at people that are professional investors like Matt Andreessen now and Ben Horowitz and Mike Morris, I mean, when you look at them individually as super forecasters, you're looking at personal investments. Is that correct, as opposed to portfolio investments? Or
it's both. If it's personal investments, and if they led the round, that's included
on the VC side of the business. Yeah, we look at both. One individual can be in 2 different areas for 2 different groups, or multiple groups for that matter. I mean, we track people. When you leave a firm, we'll track your new firm, how you're doing there. But to answer the question, the 137 is a trade secret. We're not going to share that with anybody. Our board doesn't know it. The only 3 people that know it are Joe, myself, and our data scientist. Nobody else in the company knows it, and so we won't provide that.
Thank you. Fair enough.
But it really is, just to get the kind of the visual on. It's like a professional baseball player in the sense that people, have a sweet spot of their career. They're, Ted Williams batted 400, but only for a period of time. At some point, there, you start to lose your edge, or it's because the vertical that you're really deep in sort of passes you by, and your interests distract you, and all of a sudden your batting average starts to drop.
Exactly right.
Great. Let's see. Moving on. Next question. What are the other VC investor strategies that you've observed that also produce great returns?
Wow. I'm struggling with that one. I don't think I can answer it.
Yeah, I think here's what they claim. I'm sure that you've had other VCs on your presentation before, Lindsay, and I'm sure they do. I'm sure this is right for some of them. They have amazing deal flow. They came out of, you know, Google, and they met a bunch of people there. They came out of PayPal. They met a bunch of people there, and those people went on to create companies that they were able to get into. You know, that's wonderful. If you have that kind of deal flow, that's, hey, leverage it. That's what VCs are in the business of doing. And then they whatever their magic is, whatever they claim that, you know, their methodology for identifying, some do, as you know, as we say, there are, I think, what, 27 partners or something like that at VC firms that are super forecasters. So, you know, there are VC partners who actually do have deal flow. They have the ability to identify these companies. They're just, you know, they're the exception. I mean, I don't know how many VC partners there are, but there's a lot more than 27, and there's 27 super forecasters. Joseph,
Thanks,
anything
Fred.
to add to that?
No.
Yeah.
Next question.
Actually, Fred and Joe, that seems to be all the questions that I've pulled through so far. So, you know, if there's anything, David, that you guys would like to add, please do.
Directed at Fred directly. It was how long will it be before all VCs do what Trac does?
Yeah, I got that question on an investor call with 4 investors, very knowledgeable and people who started some very substantial broker-dealer companies here in San Francisco. And they said, won't everybody do this? And we get that question, how long will our alpha will be? And Joe and I are up front. We think the alpha will be squished out of this within 5 years. But I said the same thing 5 years ago. I said, well, hell, in 2014, when we came up with CrowdSmart, we were 90-something% accurate, and you know, and we still are more than 80% accurate on our predictions. That hell, everybody's going to do this in 5 years. Well, it's been 5 years and nobody's doing it yet.
And I would argue you get into the market and you establish a brand,
yeah,
and people want your name on the cap table because it's going to help attract other funds and make it more likely it'll be a predictor of future success, your brand itself. So I think that's the opportunity there, is to get out there, put a big stake in the ground, and you know, be the leader, and that'll help sustain some advantage.
Thank you, Lindsay.
It's also an argument why you want to invest now.
Now, yeah, now.
That out.
Perfect. Well, gentlemen, it was a very much a true pleasure having you join us today. To all of our attendees, myself and the Trac Unicorn team will be following up with everyone individually. So if there's any other questions, we can get you in direct contact with the team. Happy Friday, and we look forward to speaking with you all soon. Have a great day.
Thanks.
Bye-bye, everybody.